Okay, let's dive right into this explainer. Every single year, millions of Americans open their mailboxes only to find a pretty scary letter saying their mortgage servicer is changing. And man, it's a moment that causes instant anxiety, right? You open the envelope and suddenly, the company you've trusted with your monthly payments for years is just out of the picture. But hey, don't worry. By the end of our time together today, we're going to demystify exactly what happens behind the scenes. You're going to understand how to navigate this incredibly common administrative hurdle calmly, methodically, and honestly, like an absolute pro.
So let's tackle that immediate panic borrowers feel when they get that transfer notice. It's completely natural to look at this paperwork and immediately start spiraling. You're probably thinking, wait, who do I actually pay now? Are they going to lose my payment? Was my loan sold behind my back? Or, hey, did my debt just magically disappear? Well, spoiler alert, it didn't. Look, the mortgage process is a giant, complicated puzzle, and because it's so opaque, it is super easy to jump to some pretty wild conclusions.
Now, it's really common to just immediately assume the worst, but let's clear the air and bust a few of these myths right off the bat. A letter in the mail absolutely does not mean your loan was automatically sold to a brand new investor. It also certainly doesn't mean your mortgage debt has just vanished into thin air. I mean, you don't get a free house just because the paperwork moved to a different zip code, right? And while you should definitely always be cautious about where you're sending your hard-earned money, a legitimate transfer notice is not an automatic scam or fraud. We just need to get these myths out of the way before we look at what's actually happening.
Let's use a super simple analogy here to separate the company that merely processes your payments from the actual investor who holds your debt. Think of it exactly like renting a house. The mortgage servicer, they're just the property manager. They collect the rent, answer the phone when the sink is leaking, send out the monthly statements, and manage your escrow accounts for stuff like taxes and insurance. The note owner, on the other hand, is the landlord, the actual owner of the property asset. You see, banks frequently sell servicing rights to generate quick capital. It's effectively just swapping out property managers. Just because the management company changed, it doesn't mean your landlord changed.
So the absolutely crucial point here is that a servicing transfer changes the account manager, but it does not automatically change your interest rate, your principal balance, or your actual note. The old servicer, which the industry calls the transferor, is going to stop collecting your payments. The new servicer, the transferee, steps in and starts collecting them. They'll give you new payment instructions, and your online login is definitely going to change. But your actual mortgage and deed of trust, they remain exactly the same. The catch, though, is that while the legal reality stays identical, the actual behind-the-scenes mechanics of making that digital switch, well, they can be incredibly bumpy.
And that brings us to something called loan boarding. This is the highly vulnerable mechanical process of physically moving your data from one company's computer system to another's. Think about all the incredibly detailed data tied to your mortgage right now. Your property address, payment due dates, your exact principal balance, tax data, insurance data, all of it. Every single byte of that data has to be extracted and loaded or boarded into the new servicer's platform. And let's be real for a second. We're usually talking about legacy banking software here. We're talking decades-old code trying to talk to slightly newer code. It's a purely operational process, but man, it carries tremendous risk for you.
Because you've got humans and some pretty clunky computer algorithms involved in this boarding process, mistakes inevitably happen. It's just a fact. A payment you mailed to your old servicer right near the transfer date might just not show up with the new one. Or the new company might board the completely wrong interest rate if you have an adjustable rate mortgage. They might miscalculate your escrow, suddenly issue a false shortage notice demanding thousands of dollars, or accidentally duplicate property inspection fees from literally years ago. Now, this usually isn't malicious. It's simply the friction of shoving massive amounts of complex financial data through some seriously archaic systems. So, this builds into a highly actionable strategy for us. You need to audit your own transfer. Literally, take your final statement from the old servicer and put it side by side with the very first statement from the new one. This comparison is going to be your best friend. Look at the principal balance on that last day with your old servicer. Does it perfectly match the starting balance with the new guy? Do the exact same thing for your interest rate, your total monthly payment, and especially your escrow balance. Doing this simple cross-check is without a doubt the absolute best way to catch a boarding error before it totally wrecks your credit score or drains your wallet.
Now you might be wondering, do they just spring this on me? Luckily, no. Under federal rules known as RESPA and Regulation X, you aren't just left in the dark. You are guaranteed a specific timeline of notices alerting you to the exact effective date of the transfer. This gives you a vital grace period. Generally speaking, your old servicer has to provide notice to you at least 15 days before the transfer date. Then, your new servicer has to provide their own notice no more than 15 days after that date. These notices are absolutely critical because they draw a line in the sand. They dictate the exact cutoff date you stop sending money to the first company and the exact start date the second company will begin taking your payments.
If you look closely at that required notice, you're going to see a very specific, legally mandated phrase that proves your loan contract hasn't changed. The Consumer Financial Protection Bureau strictly governs these transfers. In fact, their model notice actually dictates this exact bulletproof phrasing. Nothing else about your mortgage loan will change. Seriously, that sentence is your get-out-of-jail-free card. It is your federally mandated reassurance that only the payment processing is changing. If the new servicer suddenly claims, "Oh, your term shifted or your rate went up," this piece of paper is your ultimate proof that they just made a boarding mistake. To protect yourself from those inevitable boarding errors we talked about, you need to shift into action mode and immediately save this specific checklist of documents. I like to call this your transfer defense toolkit. You're going to want to keep both of those transfer notices we just discussed. And yes, save the physical envelopes or the email timestamps to prove exactly when they arrived. Keep your last 3 statements from the old servicer and your first 3 from the new one. Most importantly, capture undeniable proof of your payments during that transfer month. Save your canceled checks, certified mail receipts, and take screenshots of your online payment portal. Because remember, your login to the old system is going to get abruptly deactivated, and you will completely lose access to all that digital history.
Now, red alert here. If you are currently in loss mitigation, forbearance, or bankruptcy, you need to pay extra attention. These complex legal statuses are highly susceptible to just disappearing into the digital void during a transfer. Loss mitigation includes things like loan modifications, repayment plans, or short sales. Just imagine, you submitted a massive, fully completed modification application to your old servicer, and right before they approve it, boom, the loan transfers. The new servicer might claim they have no record of it and aggressively push toward foreclosure. If you are in one of these vulnerable situations, you absolutely must meticulously document your confirmations, denial letters, and trial payment plans.
If a payment does get lost, your first instinct is probably going to be to grab the phone, call customer service, and argue. Don't do it. We all know how incredibly frustrating those endless hold times and robotic menus can be anyway. Phone calls might feel productive in the moment, but legally, paper trails win every single time. First, gather all that saved proof from your toolkit. Second, send a formal written request for information. And third, if you've identified a concrete mistake, escalate it by sending a written notice of error. Following these exact steps creates a solid legal paper trail that these servicers are federally required to acknowledge.
It's super important to understand the difference between these 2 powerful written tools. Regulation X gives them to you to basically force a servicer to respond. A request for information, or RFI, is exactly what it sounds like. You're just asking for data, like a copy of your payment history, your boarding records, or you're asking them to clarify some weird fees. You're seeking information. A notice of error, or NOE, is a targeted escalation. You are firmly telling the servicer, hey, you made a specific mistake here, like failing to apply my payment, and I am demanding a legal correction. Both of these have to be in writing, they need enough info to identify your account, and they absolutely must be sent to the specific address the servicer designates for these requests.
Ultimately, what you should take away from this explainer is that you have the power to protect your biggest asset. You just need to track the transfer and verify the data yourself. Remember the golden rule. A servicing transfer changes the account manager, not the legal terms of the loan. Track the transfer, document the boarding, and challenge their errors with cold, hard receipts. Look, the system isn't perfect, and the operational mechanics of loan boarding can be a huge mess. But by keeping your transfer defense toolkit handy and knowing how to audit your own statements, you remain completely in control. So the next time that unexpected envelope arrives in the mail, ask yourself, are you going to be at the mercy of a banking algorithm's boarding error, or will you use the law to hold them completely accountable?